Is Realty Income still an undervalued buy now? We've got a few pieces of news that will affect that decision. We can also see it has been hammered down 24%, and we're talking about over the last 5 years. Today's episode, we want to go through a few pieces of news that you may have heard. One of them talking about the possibility of interest rates not being cut this year. And the second one is going to be around the closure of Family Dollar and Dollar Tree stores of around 1,000, which this is something that they do get or tenant from Realty Income, so it will affect their decision. We're also going to do our usual analysis. We're going to look at the dividend safety. We will bring in some financial metrics, and the main part of this will be looking at the valuation of Realty Income, the intrinsic value that we do derive, as well as our acceptable buy price given our investor margin of safety, and look towards Wall Street to see what they're forecasting for the price of this company over the next 12 months. So let's refresh ourselves on the historical performance of Realty Income. Now they are down 24% as we can see over the last 5 years. Over the last year as well, not a great performance if you are a recent shareholder, down 15%. We do note they trade in the mid to lower end of the 52-week range, whilst also offering a yield of 5.82%, which will be very attractive to investors. Do bear in mind this is a company that does pay dividends on a monthly basis. Now the first piece of news that we do want to draw your attention to is the interest rate cuts, but we also want to quickly give you a little bit of a spoiler alert towards today's episodes, as we see 3 of these analysts indicating that it is a very strong buy now. So let's get into the information and we will uncover that valuation of this company. First one is, now the article reads, again released not too long ago, that not to sweat the prospect of no Fed cuts taking place in 2024. Now this comes after, as we can see, the markets dropping the essential percentage that they believe of a first cut in June. It is down to 55%, and that was in fact 70% just a few weeks ago. So we can see the market is now becoming a little bit more unsure of whether or not we will see any interest rate cuts in 2024. Not too long ago, we were talking about 5 or 6 cuts. Now we were talking about 2, and we can see that there is the possibility that as the months go on, there may be no rate cuts. Now, one of the reasons that we do need to consider this for Realty Income is the fact that they do hold around 22 million worth of a debt principal on their balance sheet. The only thing that I would say is there is no real worries in myself when I am looking as an investor of this company, given the fact that the majority of the debt that they do hold is long-term, and we can see in actual fact it is held at around 3.77%. So what I would say is, in conclusion to the response of interest rates possibly not being cut in 2024, 86.4% of the debt that Realty Income does hold is not maturing until 6.7 years at a rate of 3.77%. If you want to look at 100% of their total debt, it doesn't mature on average for 5.9 years and at a rate of 3.89%. So in my personal opinion, I do believe the market will have changed in 5 to 6 years. We won't be seeing a very high interest that we are seeing now in 2024. So for the first news that we did have of potential no rate cuts, I don't believe this is a major worry for Realty Income. Now we're going to move on to the second piece of information today, which is, as we can see, Family Dollar and Dollar Tree, both tenants of Realty Income, to close around 1,000 stores. Now, if you were to see this information, it may scare you, especially if you do understand how Realty Income works, because when we do look at their client diversification, we can see in their top 20 clients, 3.3% of their annualized contractual rent does in fact come from Dollar Tree and Family Dollar. So if you are thinking, wow, 1,000 stores are being closed, this is really going to affect Realty Income, especially given it is essentially their third biggest client in terms of revenue, then I would say let's take a deep dive. Let's understand the number of stores that these companies hold. What is the percentage of that in relation? So we have 1,000 stores to be closed. So let's start off with Family Dollar. Family Dollar, it is an American chain. We can see they have over 8,000 locations in all states, including Alaska and Hawaii. So 1,000 stores spread between 8,000 from Family Dollar. When we add that to the 15,000 stores that we do see from Dollar Tree, we are talking about 1,000 stores being a very, very small percentage of the total number. 15 as we have here, plus 8, over 23,000 stores are combined to essentially give us the 3.3%. Now we're talking about 1,000 of these stores closing. Not only do I not see that as a massive issue for Realty Income, but I also believe there will be other clients that will come and take their place. We have Dollar General, we have Walgreens, we have 7-Eleven, we have FedEx. There are a number of clients, and there could be new clients that come in to take those stores off their hands. So I wouldn't say this is a massive concern. Instead of 3.3%, it would come down very slightly, whether it's 3.0% to 3.1%. So for me, this isn't a major worry right now. And that is something that I would say doesn't cause me any concern as a Realty Income shareholder. And just to confirm that information that we did run through with the article itself, we can also see that it isn't something that is going to be happening straight away. In fact, Family Dollar will be closing 600 locations this year, 370 locations over the next few years as the store leases expire. So again, you may have seen the headlines and got really worried if you were a Realty Income shareholder or someone who was looking at adding Realty Income to your portfolio. As I mentioned, they do have 8,000 stores in the US. So this will be a very small percentage. In fact, it is clear now only 600 this year. Now we can take a look at the numbers and we will revert back to some information from their investor presentation. But when we're looking at the income statement of companies, especially real estate investment trusts, we want to see at least 5 to 10% increase year on year. What we can see over the last 10 years, they have increased their top line more than 4 times from 934 million all the way to 4.1 billion. So we do see nice growth, and when we do take a look at it in terms of this graph, we can see it is moving in the right direction, moving upwards. And the one thing that I would say that we won't cover in today's episode, as we have covered it previously, but with their merger, their acquisition of Spirit Realty, there will be a lot of synergies that we do hope from 2024 onwards will show up in the annual report, with an increase in their top line revenue as well as their bottom line net income, which we're about to look at now. So bottom line has also increased, going from 271 million to 872 million. So again, when we do take a look at it from a graph, it is a little bit more inconsistent. In fact, from 2014 to 2021, there is very minimal growth, although we do note from 2022 and 2023, we do see some nice bounce from 21. But again, 22 to 23, relatively little movement. So whilst this is a REIT that is increasing their top line at a very nice rate, their bottom line does struggle a bit over the period, something we can factor in when we do look at our margin of safety. Now, in terms of the balance sheet, what I always like to do is a quick health check, total cash versus total debt. What we know in December 2014 was they held around 4 million on their balance sheet. December 2023, 233 million. So their cash position has also increased over the last 10 years. Again, it is very inconsistent, but we do know in the more recent year, they do hold a fair amount of cash, and this will be used in one of our valuation models. In terms of their total debt, numerically and directionally, always important to note, it has gone from around 4.9 billion in December 2014 to 22.1 billion. So no surprises that a REIT has increased their total debt. It is something that is very common for them, and we can also see that from the graph. It is rising year on year. As they do get larger, they do take on more property acquisitions. It is only natural that their debt also increases. Now, what I always like to do is do a comparison, a performance of how they look versus others in the industry. So we have the retail REIT industry, a lot of well-known companies here, REITs in particular, Simon Property Group, Kimco Realty, Regency Centres, and a few others, as well as ones we have reviewed on the channel recently. Now, over the last year, no surprise, Realty Income has been plummeting. It is down 11%. Now, slightly different to what we saw at the beginning, because this includes those dividends reinvested. They were the worst performing. Over the last 5 years, no surprise again, a very poor performance, second to worst in fact. And it is key to remember that past performance is never an indicator of future performance. When we do extend this to the last 10 years, however, interesting to note that they are in fact the best performing REIT from these competitors that we have analysed today. But again, future performance isn't indicative of their past performance. So it is something we like to do as one level of our review. But as always, don't take this information and expect it to happen again. It could be better, it could be worse. That is why we are investing and doing time into research of this company and the underlying numbers. In terms of ownership insiders, well, we see 0.1%. We see around 200,000 worth of insider selling. Not a very large amount, and one we have covered before, but as always, just to make transparent in case there are new viewers for this episode, Larry Chapman, one of the directors at the back end of December last year, did sell around 3,500 shares for a transaction value of $200,000. Again, this isn't something I would say as a bearish signal. He could sell for reasons we don't know, whether it's personal or financial. Institutional ownership, well, that sits at 71%, 1.71 billion worth of sales over the last 12 months. A lot more buying over the same period, as we can see, and therefore when we do analyze it, we can see Q1, Q2, Q3 and Q4 of 2023 showing more buys by institutions than sales. And in fact, whilst we don't have the full Q1 data set, what we have so far, a lot more buying, 9 million versus 20,000 sold. So we can say not just over the last 12 months, but also in the latest quarter, insiders and institutions are buying a lot more shares than they are selling. One thing that we did want to point out to those that may be new to Realty Income or don't know this, but there is a lot of geographical diversification with their clients in terms of rent, and in fact they have 12.6% coming from the UK. We do in fact see quite a large number coming from the US. We have the first US coming in at Texas, 9.6%, California 5.2%, and Florida at 5%. So nice to note that there is that geographical diversification, and that doesn't just necessarily mean the UK. Only recently they did purchase 82 assets across 5 countries, and we are talking about the third largest sporting goods retailer, which was Decathlon. A lot of people, I'm sure, would have heard of that. So it is important to understand that Realty Income doesn't just focus in the US, and again, it's not just the UK, a lot of European companies and tenants, so that is good when you are considering that they are not just specifically relying on a certain number of tenants. So when you do read things like Dollar General, Family Tree are closing down stores, it isn't the end of the world by any means. And as I've wanted to point out here on this investor slide, is that they are growing their international portfolio. In fact, as we see, they did start off a sale and leaseback from Sainsbury's in May 2019, which is a very large grocery store in the UK. And it just doesn't stop there. When we do take a look at the next slide, we can see they are doing a lot of investment over the last few years in Europe. And the main thing that I really wanted to point out here is that they do have a lot of very strong European clients. As someone from Europe, we can see, and I do know a lot of these, they are very strong. We have B&Q, Asda, Sainsbury's, Tesco, Decathlon that we did mention earlier. And in fact, we can see here that Tesco and Sainsbury's are the top grocers in the UK. Carrefour, the second largest in Spain. So just want to put at ease, and this is again just my opinion, always do your own due diligence, but there isn't any real worries based on the information that we have available to us on these store closures, as well as just moving forwards for Realty Income. Now, before we jump into the metrics and the valuation, just to let you know, we have released our latest free weekly article. We do run through quite a lot of undervalued dividend stocks, talk about dividend yield theory. If you want to gain free access instantly to any of these articles, all you need to do is click on that pinned comment below to sign up, and off you go. Dividend safety then, let's talk about the metrics. We haven't done this in a while, so 80, it is safe still. Market cap 46 billion, it is a large cap company. Now, in terms of the latest recessionary metrics, well, in 2007 to 2009, they did continue to increase the dividend. They had negative 1% recession sales. This was still above the average growth, which came in at negative 12, and they did marginally beat the S&P, negative 43, with the S&P coming in at negative 55. Dividend growth then, not the greatest. Remember, what we do want to advocate on the channel is that you always beat inflation, which comes about 4% on average over the last 40 years in the US. If you get less than 4% year on year, whether it's dividends, salary, other income producing assets, you are in fact taking a pay cut and losing your purchasing power. Nice to note though, over the last 20 years, on average, it has increased by 5%, and they are a dividend aristocrat given they have increased dividends consecutively over the last 25 years or more. And we can see they have also been paying dividends for the last 55 without a reduction. Now, in terms of dividend yield theory, for those that are new to the channel, it does state the company is undervalued when the current yield sits above the 5-year average. We get a double sign here, not just on the yield at 5.82 above 4.47, but also the forward P to AFFO, the adjusted funds from operation, which is used for REITs, being lower than the 5-year average of 17.7, and we do also note it is lower than real estate sector P to AFFO. So lots to like about the undervaluation aspect of Realty Income, but remember, we don't look at any of these models in isolation. We will conclude towards the end. As always, I love looking at the free cash flow data, but for REITs, a lot more volatile. Adjusted funds from operation payout. Now, what we want to see below 90% for the majority of REITs. And what's nice to note, in 2014, it was 85%. Since then, it has decreased over the last 10 years, 74% expected in 2024. So the dividend, based on this information alone, does look to be very safe. What I also like to note is the adjusted funds from operation per share. Similarly, for other companies, we look at the free cash flow. It is increasing year on year. It is also very consistent. 2024 expected to go even higher, which does lead me to believe that we will see some nice synergies with the acquisition of Spirit Realty. We can see the percentage as well year on year of that per share growth, 2024 at 4%. In terms of sales growth then for REITs, as we did run through on the top line, 5 to 10%, we can see every year pretty much equaled that or better. The last 3 years showing some very strong double-digit growth. And as we did run through at the beginning of the episode, we can see they have increased their top line in a very strong manner. One thing we haven't touched upon yet is the fact that they do dilute your position over the longer term with increasing shares, issuing equity. In fact, this is something that we don't like to see, but very common with REITs. Main reason they do this is to fund their property acquisition, as they don't retain a lot of that internally generated cash flow. They do pay the majority of that as dividends. But what I would say is, if you do like REITs, do take a look at REITs in your own portfolio to see how this compares in terms of the rate of dilution. ROIC for REITs, 3 to 5%. We can see Realty Income is about that, 3 to 4 over the more recent period. Not too bad, as long as it gives me faith that management are able to effectively allocate their capital. I am happy to see those numbers. And when we take a look at the operating margin, it is a little bit inconsistent, but we do see it has decreased over the longer term. I would like to see this come back up in 2024, and I will be very interested to know how that acquisition has gone for Realty Income moving forwards. Then finally, we do look at the net debt to EBITDA level, something to keep an eye on, especially as it correlates to both dividend safety as well as balance sheet strength. Remember, this is the earnings before the interest, tax, depreciation, amortization, and shows us the number of years it would take the company to pay off all of their debt net of cash on hand. Below 5.5, they have really struggled to get around that. In fact, they've straddled around that quite a lot over the last 10 years. The one thing I would say, incredibly strong to see, coming down to 4.68 in 2024. If this materializes, then I wouldn't be surprised if the dividend safety does rise up into very safe territory above the 80 that we currently have. So what's important now is for us to take a look at the valuation. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now let's get through to the first valuation model. We're using the multiples valuation model, companies in a similar sector and size. We have their P to AFFO multiple, the average, multiplied by the EPS, and we have the P to AFFO of O right here, giving us an intrinsic value showing some very strong signs of undervaluation. Do keep in mind, though, we don't look at any of these models as well in isolation. We then have the dividend discount model, where we have the growth year on year, average just over 3%. I've gone slightly above that, as we can see, but not too far off at 3.25%. We then get to the intrinsic value, again fairly in line with the previous model, showing us some strong signs of undervaluation. We then have the DCF model with the free cash flow year on year, average growth rate at 20%. We have gone a lot more conservative, below analyst and management targets. Discount rate at 8%, we got the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. And again, a pretty similar intrinsic value, showing some nice signs of undervaluation. So the intrinsic value for today's episode is just the average of these three models. Don't forget, you can grab a copy of this model if you want to run through companies of your own to get to the intrinsic value as well as your own acceptable buy price of companies in your portfolio, or even just companies that you're interested to look at. Margin of safety then, as always, we do start off with 10%. We use that if we believe it meets three criteria: a wide moat, strong financial metrics, and good forward-looking data. So then we move on to 15% and essentially keep moving till it's near the current trading price. And we would say it's got near enough a 20% MOS level based on our estimates and judgments. Now, in terms of whether or not Wall Street see this as a buy now, we can see they have a price target of $61. They do see this as a nice company in terms of upside of 15% as a strong buy, one that they do believe should be in your portfolio. Now, as always, in terms of the news that we have had recently, in my opinion, I don't see it will have much of an effect on Realty Income moving forwards. It isn't one that would change my mind, as this is one that I do hold in my own portfolio. For me to add this, I would need to see it go a little bit lower, as I do have a fair enough amount in the portfolio. But we are interested to always hear your thoughts. Is this one you're looking to add? Maybe one you've got on your watch list for a certain price. Maybe you hold it and you're a little bit worried considering selling. Always let us know your thoughts in the comments below and we will respond. As always, if you've enjoyed today's episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.